For 10 solid years, I did what I was told. I followed the advice of every financial guru, every HR rep, and every well-meaning person in my life. I diligently, almost religiously maxed out my 401k. I'd watch that percentage come off my paycheck before I ever saw it. And I felt so responsible. I felt smart. I was playing the long game, building what I thought was a mountain of money for a comfortable, golden retirement. I had this vision of an older, wiser me, sitting on a porch somewhere without a financial care in the world. All because I'd done the right thing. But one day, a nagging curiosity I just couldn't shake made me take a truly hard look at the numbers. I'm not talking about the headline balance I'd proudly watch tick up. I mean a real look. I started digging into the statements, researching the funds I was in, and running the math on what my future actually looked like. And that's when the floor dropped out. My mountain of money wasn't a mountain at all. It was a sandcastle, and the tide was rolling in. Thanks to a toxic cocktail of hidden fees I'd never fully appreciated, a complete lack of control over my own money, and the silent but relentless erosion of inflation. My safe investment was barely growing at all. This is the story of how I woke up, rejected the broken, outdated 401k system so many of us blindly trust, and took back control of my financial future. And I'm going to show you exactly how you can do it, too. Let's start with the first crack I found in the 401k's foundation, the fees. We all know there are fees, right? It's a managed account. Of course, there are fees. But what I had failed to appreciate, what I think most people miss, is how truly devastating these fees are over time. It's like a tiny leak in a giant dam. At first, it seems insignificant, but give it 30 or 40 years, and that tiny leak can cause a catastrophic failure. Your 401k plan is convenient because your employer sets it up. But that convenience comes at a steep price. These plans are run by financial institutions, and their goal is to make a profit. A huge chunk of that profit comes directly from your retirement savings in the form of administrative fees, record-keeping fees, and individual service fees. But the real killer, the one that does the most damage, is the expense ratio on the mutual funds you're invested in. An expense ratio is what the fund company skims off the top every single year to pay for its own costs. A low-cost 401k might have funds with expense ratios of 0.5%. Many have funds that are closer to 1% or even higher. Now, 1% doesn't sound like much, but let's put it in perspective. Imagine you have $100,000 in your 401k. A 1% expense ratio means you're paying $1,000 a year. Every single year, whether the market goes up or down. That's $1,000 that isn't compounding for you, it's compounding for the fund company. Over a 40-year career, that single percentage point can cost you over a quarter of your potential nest egg. It can add up to hundreds of thousands of dollars that should have been yours. I realized I was paying thousands of dollars a year for the privilege of getting mediocre returns from a limited menu of funds. That was the first domino to fall. The second, and frankly more terrifying, realization was about inflation. We all feel it at the grocery store and the gas pump. But I had never truly applied that reality to my long-term savings. The money in your 401k isn't real until you take it out. And when you do, the only thing that matters is what it can buy. This is called purchasing power. And inflation is a disease that eats it alive. Financial planners love to talk about the historical average return of the stock market, often citing a figure around 10% over the long run. That sounds fantastic, but that number is a mirage. It's the nominal return, not the real return. Your real return is what you get after you subtract the rate of inflation. Historically, inflation has averaged around 2 to 3% a year, but as we all know, it can spike much, much higher. If your 401k earns 7% in a given year, but inflation is running at 3%, your real return is only 4%. You didn't actually get 7% richer. You got 4% richer in terms of what you can actually buy. Now, let's factor back in that 1% fee we just talked about. Your 7% nominal return is now 6%, and after 3% inflation, your real return is a measly 3%. You're taking all the risk of the stock market for a return that barely beats a government bond in some years. When I ran the numbers, I saw that in some years, my so-called growth was a complete illusion. The balance went up, sure, but my ability to buy things with that money in the future had actually gone down. I was on a financial treadmill, running as hard as I could by saving, but the machine was speeding up with inflation and fees. I was standing still, or even moving backward. This isn't building wealth. This is your retirement dream being silently dismantled, 1 percentage point at a time. Now, let's talk about the biggest selling point of the traditional 401k, the tax deferral. The pitch is simple and seductive. Don't pay taxes on your money now. Let it grow tax deferred for decades, and then pay taxes on it in retirement, when you'll be in a lower tax bracket. 4 years, I just accepted this. It makes sense, right? But I started to question that logic. When you contribute to a traditional 401k, you're essentially going into business with the government. They are your silent partner on every single dollar in that account, and you have no idea what their take is going to be. You're making a bet that tax rates in the future will be lower than they are today. I want you to stop and really think about that. Look at the direction of government spending and the national debt. Does it seem more likely that the government will need less tax revenue in 20 or 30 years than it does today? To me, betting on lower future tax rates started to feel like betting on a horse that's already limping. I was building up this big pile of money, but a huge, undefined chunk of it wasn't even mine. It had a lien on it from the IRS, and the interest rate on that lien was whatever a future Congress decided it should be. And don't forget about required minimum distributions, or RMDs. Starting in your 70s, the government forces you to start withdrawing money from your 401k, whether you need it or not, because they want their tax money. These forced withdrawals can easily push you into a higher tax bracket in retirement than you ever planned for, creating a tax torpedo that blows up your financial plan. The tax benefit of the 401k began to look more and more like a tax trap. The final nail in the coffin for my love affair with the 401k was the suffocating lack of control. Your 401k money is, for the most part, locked away until you're 59 and a half. Touch it before then, and you're slammed with a 10% penalty on top of ordinary income taxes. But life happens. Opportunities come up. Emergencies happen. Your 401k money just sits there behind a glass wall, untouchable without paying a massive ransom. To be fair, there are exceptions. The IRS has a provision called Rule 70-T, which lets you take substantially equal periodic payments without that 10% penalty. But this isn't a simple get-out-of-jail-free card. It comes with incredibly strict and inflexible rules that you're locked into for years. For most people in most situations, that money is locked away. What if a once-in-a-lifetime business or investment opportunity comes along? What if you just want the freedom to retire at 55? The 401k structure essentially says, too bad, wait your turn. Even worse than the lack of access is the pathetic lack of investment choices. Most 401k plans offer a tiny menu of funds, maybe 10 to 20 if you're lucky. And who picks them? Your employer, often with guidance from the same high-fee company running the plan. You can't buy individual stocks. You can't buy specialized ETFs. You certainly can't invest directly in alternative assets like real estate. I felt like I was at a restaurant where the only things on the menu were a soggy hamburger, a stale salad, and an overpriced steak, and I was being forced to order one of them for the next 30 years. It was at that moment I knew I had to get out. I had to stop pouring money into a system that took my cash, charged me high fees, exposed me to unknown future taxes, and gave me almost no control in return. So there I was, completely disillusioned. The safe path felt like a lie. The 401k, the supposed golden ticket to retirement, seemed like a flawed product at best and a deceptive system at worst. I was angry, but then that anger turned into determination. I asked myself a simple question: if the 401k is so flawed, what's the alternative? That question sent me down a rabbit hole of research. I spent months reading, listening to podcasts, and studying what truly wealthy people do with their money. What I found is that the principles of building real, lasting wealth are shockingly simple. They don't rely on a one-size-fits-all plan. They rely on 3 core pillars: minimizing taxes, minimizing fees, and maximizing control. Now, I want to be crystal clear. I am not a financial advisor. This is not personalized financial advice. This is my story and the strategy I found that works for me. The goal isn't just to save for retirement. The goal is to build wealth. And before you think I'm suggesting you ditch your 401k entirely, let's talk about its single most valuable feature, the employer match. If your employer offers a match, that is 100% free money. It is an instant, guaranteed return on your investment that you will not find anywhere else on planet Earth. To do otherwise is to literally turn down a raise. So, my personal rule, and the first step in this new strategy, is simple. Contribute just enough to your 401k to get the full employer match. Not one penny more. But what do you do with every single dollar after that? That's where the exciting part begins. My new strategy revolves around a triad of powerful investment vehicles that, when combined, create a diversified, low-cost, tax-efficient engine for building wealth. This isn't some secret system for the ultra-rich. It's accessible to anyone. The three pillars are the Roth IRA, low-cost index fund ETFs, and real estate through REITs. This approach directly attacks every single weakness of the traditional 401k. Instead of tax-deferred, we get tax-free growth. Instead of high hidden fees, we get ultra-low, transparent costs. Instead of a limited menu of mediocre funds, we get the entire universe of investment options. It's about owning your assets, understanding what you own, and paying yourself first, not the fund managers. Let's break down each pillar. After you've secured your full 401k match, the very next dollar you save should go into a Roth IRA. A Roth IRA is, in my opinion, the single most powerful wealth-building tool available to most Americans. It's the complete opposite of the traditional 401k's dangerous tax bet. With a Roth IRA, you contribute money you've already paid taxes on. For the 2026 tax year, you can contribute up to $7,500 if you weigh under 50. If you weigh age 50 or older, you get to make an additional catch-up contribution of $1,100. Let that sink in. All the growth, all the dividends, all the compound interest your money earns for decades, the government can never touch it. You've settled your tax bill up front, at today's rates, eliminating that massive, unknown future liability of the 401k. There are no required minimum distributions, either. You know exactly how much of that money is yours, all of it. Now, there are income limits. For 2026, to make a full contribution as a single filer, your income must be below $153,000, and for married couples filing jointly, it must be below $242,000, with phase-outs after that. But for the vast majority of people, the Roth IRA is sitting there, waiting to be used. Maxing it out every year is the foundation of real financial freedom. So, you've gotten your 401k match, and you've maxed out your Roth IRA. What's next? You open a standard, taxable brokerage account and start systematically investing in the greatest wealth creation machine in history, the stock market. But we're going to do it the simple, proven way, with low-cost index fund ETFs. An index fund simply holds all the stocks in a particular market index, like the S&P 500, which is just a list of the 500 largest companies in America. When you buy an S&P 500 index fund, you instantly own a tiny piece of all 500 of those companies. The legendary investor Warren Buffett has said for years that the best thing most people can do is consistently buy and hold a low-cost S&P 500 index fund. Why? Because over the long term, it works. The key word is low cost. Unlike the expensive funds in your 401k, you can buy an ETF that tracks the S&P 500, like Vanguard's VOO, with an expense ratio of just 0.03%. That's not 1%. That's not 0.5%. That is 0.03%. On a $100,000 investment, that's just $30 a year, not the $1,000 you might be paying in your 401k. That cost difference alone can add up to hundreds of thousands of dollars over a lifetime. The final pillar adds an asset class that behaves differently from stocks and provides a powerful hedge against inflation: real estate. No, I'm not telling you to become a landlord and deal with tenants and toilets. You can get the benefits of real estate passively from your brokerage account using real estate investment trusts or REITs. A REIT is a company that owns and operates income-producing real estate. Think apartment buildings, shopping malls, warehouses, and data centers. By law, REITs have to pay out at least 90% of their taxable income to shareholders as dividends. This creates a stream of passive income. More importantly, Real estate tends to do very well during inflationary periods, as costs go up. Landlords can charge higher rents, and the value of the properties themselves increases, protecting the purchasing power of your portfolio. Just like with index funds, you can buy a diversified REIT ETF like VNQ, which holds a basket of hundreds of different REITs. This adds another layer of diversification and inflation protection that is almost impossible to get inside a standard 401k. Okay, let's bring it all together into a clear, step-by-step action plan you can start today. Step 1. The 401k match. Go to your HR portal right now and find out your employer's match. If they match up to 5%, set your contribution to exactly 5%. You are now collecting your free money. Step 2. Open a Roth IRA. Go to a low-cost brokerage like Vanguard, Fidelity, or Schwab. It takes about 15 minutes. Set up an automatic transfer to fund this account, with the goal of hitting the annual maximum. For 2026, that's $7,500, or $8,600 if you're 50 or older. Step 3. Open a taxable brokerage account. At the same firm, open a standard brokerage account. This is where all your investment dollars will go after you've maxed out your Roth IRA. Step 4. Automate your investments inside your Roth and taxable accounts. Set up automatic investments into low-cost index funds and REITs. A simple, effective allocation might be 80% in a total stock market ETF like VTA and 20% in a REIT ETF like VNQ. The key is to make it automatic. Wealth is built on consistency. Step 5. Review once a year. Once a year, look at your portfolio and rebalance back to your target allocation. This forces you to systematically buy low and sell high. That's it. That's the whole strategy. It's simple, it's transparent, and most importantly, it puts you in the driver's seat. Look, the world of finance is designed to be confusing. They want you to think you need an expensive guide to navigate it. You don't. The decision to stop blindly pouring money into my 401k was the single most empowering financial decision I have ever made. It was the moment I stopped being a passive participant in my own future and became the architect of it. The old advice to just max out your 401k and hope for the best is a relic from a different time. Today, you have to be your own financial advocate. You have to question the conventional wisdom. This journey is about more than numbers on a screen. It's about freedom. The freedom to retire when you want, not when the government says you can. The freedom to pursue work you love. The freedom that comes from knowing you have a resilient financial foundation that you built yourself. If this resonated with you, subscribe to this channel. My goal is to keep breaking down these topics and give you the actionable knowledge you need to build real wealth. And let me know in the comments, what is the one thing about your 401k that worries you the most? Don't let your financial future be a default setting. Take control. Start today.